mode.
Good afternoon and welcome to today's Premium Account Short Form Market Update. The information does not take into consideration the specific needs, investment objectives or financial situation of any person. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hinde, current Managing Director of Global Equity Management and the Investment Manager for the Investor Signals Unit Trust. I have 17 years of experience in the financial services industry and a current licensed securities advisor. The format for today's presentation, it is a short form webinar, so we do a quick summary of the macro update. We look at the trends within the ASX Top 50. We review our recent transactions and conclude with a short-term summary of portfolio allocations and the Australian share market outlook. The services that we provide are up on screen there, and if you'd like to know more about those, please contact either myself or Christine, info@investorsignals.com. Up on screen there's a graph of the XJO, and generally speaking the macro data coming through from the US, we saw better than expected retail sales for September. We saw better Case-Shiller house price index data coming through. The 20 largest US metro cities rose 1.3% from July, and on an annualized basis up around 13%. There were some minor softer consumer confidence numbers in the recent period, and I guess we put that down to the US government shutdown and obviously worries about the circumstances that were developing there on Capitol Hill over the course of the last month or so with the budget and the debt ceiling, but in general that hasn't seemed to flow through to weaker retail data. From an earnings standpoint, we're about two-thirds of the way through the S&P 500 earnings season. Generally, we're seeing US earnings beat expectations, as we are out of Europe at the moment. From a valuation standpoint, we're seeing the Australian equity market perform quite well as a result of a combination of our resource stocks doing better than expected, with good quarterly production data coming out of Rio, BHP and Fortescue, and also the banking stocks really starting to perform, where we've seen the results come out of ANZ, and the headline number for their 2013 result looked good. We saw an increase in the dividends. Tomorrow we have NAB reporting their FY13 results, and then on Friday we have Macquarie, and then next week we have Westpac and CBA. As the banks are coming into their ex-dividend period, I'd expect the banking sector to continue to remain well supported. From a valuation standpoint, the XJO is trading at 15 times forward earnings. We're not seeing a huge amount of evidence yet that we're seeing earnings pick up to support the higher PE valuation of the XJO. But that's not unusual. Sometimes, what the message that the market is telling us is that the market thinks that synchronized global GDP will occur next year, and that's a result of essentially central banks coming to the aid of the global economy and providing stimulus. The market's saying that they don't expect the Federal Reserve to pull back on their stimulus measures anytime soon. The general consensus is that the US will pull back probably in the second quarter of next year, but I think that's only a maybe at best. So ahead of the market anticipating a pickup in earnings, we could see PEs expand, even up to 16 or 17 times earnings, and we'd see the yield on the market compress down below 4%. The risk occurs that if then the earnings pickup doesn't occur, then the market will clearly be overvalued. Right at the moment, we're willing to give the market the benefit of the doubt that we're probably more in this camp that we will have synchronized global GDP expansion in 2014, which should underpin the value for equities. With very high PEs at the moment on an individual stock basis, we're reluctant to position portfolios too aggressively, so we're still of the view that the right strategy is owning select stocks and selling covered calls over those. On that note, let's take a look at the transactions that we've been conducting over the course of the last week. We've been buyers of AGK. We've seen AGK come out with a slight profit warning where the market was looking for around 8% EPS growth. The company's guided to numbers that will probably deliver somewhere more around flat to 4% earnings growth. But I think on a 2 to 3 year outlook, the picture for AGK is still very positive. We have it on 2014 numbers trading on about a 4.25% dividend, trading about 14 times earnings. We're happy to be buyers of it at or near this $15 level. Up at around $16, the stock starts to get expensive, but we're happy to position on the long side of AGK coming into the dividend in the first quarter of 2014. The other name we've been active in is Amcor, so we've been buyers of it on the dip here. We've been waiting for the rally up higher, and we're selling the calls at 11.25. At the recent AGM, Amcor came out and confirmed that the underlying earnings within the Australian spun-off division, or soon-to-be spun-off division of Amcor, which we now have a date on that in December. The demerger will occur. The underlying trend within that Australian division has actually been a little bit stronger than the market or management had expected, and I think that just kind of bodes well, albeit our strategy is not to retain that ownership. We'll sell off the shares that we receive in the in AAPD, which is now going to be called Aurora, and will remain exposed to the primary company, which will remain Amcor, which obviously have more of the international assets in it. So again, our strategy here is to own Amcor. We think the demerger will unlock value for shareholders. We think the underlying business post the demerger will still grow at somewhere around 10% per annum. And we think that the stock's probably worth closer to sort of this 11.25 level, and we'll certainly continue to be buyers of it over the next 6 months or so. Right at the moment we own it, and we've been selling the 11.25 calls, and we're collecting roughly around 22 cents a premium for those, keeping in mind the stock will go into its dividend period in February, March, and we'll look to try to keep exposure to Amcor throughout that dividend payment period. ANZ, so on a forecast basis, the company's looking for around 4% revenue growth and maybe 2% cost growth. What that should mean on a forward outlook is that ANZ deliver around somewhere around 3% earnings growth, and on that basis, we still have the view that the stock's reasonably full value. The dividend's been increased to 91 cents, but happy to own ANZ at or near these levels. We're selling the European calls, collecting the upcoming dividend, and essentially starting to form a view that the banks will come into a period of consolidation post this dividend period coming up. So we've been active in buying ANZ and selling those European calls, as is the case with ASX. We've been owners of ASX at lower levels. We've been waiting for the stock to rally. We've gone out and sold the $37 calls into the March period of the new year. They're European style, and we collected $1 for those. So when you allow for the upcoming dividend, we're effectively getting an exit price on ASX close to around $39, and I think that sort of captures the recovery for ASX, given that the underlying business is not likely to deliver substantial earnings growth. We haven't seen a major improvement in equity volumes. At around $39, it would put the stock on a 4% dividend yield. It's currently trading at around 5% dividend yield. I think sort of that's the range from $35.50 up to $39, so we're sitting at the top end of that valuation range with ASX, so we've certainly been active there. AZJ, this is a name that we've just started taking profit on at or near these levels. We would certainly welcome an opportunity to buy back in on a pullback back to around $4.50. BHP, so we've seen the September quarter production numbers come out a little ahead of expectation. I spent some time last week talking about the numbers in iron ore, coal, and the petroleum or energy division of BHP all being strong. From a valuation standpoint, we have BHP trading at about 13 times next year's earnings and trading on about a 3.5% dividend yield, and we're looking for upgrades in earnings from around 10% growth to as much as around 15% growth, and that was where we're getting to our price target of around 39.50 on BHP. So we own it at lower levels, and we've gone out and sold the covered calls. We're getting around 90 cents for those covered calls, and that's giving us an effective exit price up at around $40.50. Again, in all these instances that I'm referring to where we're delivering the stock under the covered call, we're generating in excess of 20% capital growth, and in the event that the stock largely moves sideways or doesn't hit the top end of our capped call level, we're generating around 10% of cash flow on an annualized basis as a combination of the dividend and the option premium. Brambles, from an earnings standpoint, as I've chatted a lot about, Brambles should deliver around 5 to maybe 8% earnings growth. We've got the spin-off of the recall assets that'll effectively strip 75 cents of value from the current BXB share price. Obviously, owners of BXB will receive the recall shares. To the extent that we're involved in that, we'll look to sell off the recall shares. We won't continue to hold them as part of the portfolio. But as BXB goes through this current sell-off here, I think it presents another buying opportunity. BXB should deliver that sort of 5 to 8% earnings growth. We're owning it at or near these levels, and we're selling the covered calls, trying to get around 22 cents for those. For where we had bought the stock at lower levels, and throughout this rally just over the last week or so, we started selling calls both at the at the 972 level, which we collected 20 cents for, and also we went out a little bit further into March and sold the $10 calls, which we collected 26 cents. But our base case on Brambles is that around this sort of $9 level it becomes attractive. Up at around 9.75 the stock starts to get a little expensive. Also Coca-Cola, we've been active in Coca-Cola. We do own it in some cases here at lower levels, but up at these levels the stock starts to get a little expensive for us. At around $13 odd, the stock's trading on about a 4.5% dividend yield and trading at about 17 times forward earnings. The company's probably likely to only grow earnings at a very low single digits, maybe 1-2%. I'm not hearing enough commentary out of the company on cost control to get bullish on Coca-Cola yet, but we've been selling the covered calls there at around the 13.22 level and generating around 25 cents for those. Again, our base case here is that we're getting over 10% cash flow out of it, and over the next 12 to 18 months we would look for Coca-Cola to recover back up to around $14, but I think we need to see a better cost control plan coming out of the management of the business over the coming months. So we've been active there in Coca-Cola, as has been the case with Computershare. We own this one here at lower levels as well, and we've throughout this rally we've just taken advantage of selling the covered calls up at this 10.75 level. We're generating around 25 cents, so giving us an effective exit price of around $11. If Computershare bounces sideways, and from a valuation standpoint, even though we're looking for around 10 to 15% earnings growth in 2014, the stock's expensive, trading at about 17 times forward earnings on a 3% dividend yield. So if we run into resistance at or near these levels and it tracks sideways, we're boosting that dividend yield up to around 10% per annum as a result of the dividend and the call premium. The other stock we've been active in is Fox. So this in the middle of their $4 billion share buyback, earnings growth of around 10%. We own it at lower levels, and we're effectively taking profit on Fox anywhere from sort of this 37.50 up to 39.50. I think that sort of caps the current rally. NAB, we've been active in. Here we've just started to sell some covered calls. NAB reports their earnings results tomorrow. NAB will probably deliver somewhere around 5% EPS growth as the yield compresses down to around 5.5%. A lot of the mispricing between NAB and the other banks has started to narrow at around sort of this $35 level post the div. I think NAB consolidates and moves sideways, so we've taken advantage of collecting some call premium there on NAB, and that's delivered roughly sort of $1 of additional income there over the next few months from NAB. Transurban's another name that we've been active in. So again, on this little pullback here, happy to take a look at buying Transurban ahead of the upcoming December dividend. So we want to own it at around this 7 to 7.15 range, selling calls up at around the 7.40, 7.50 level. Telstra we've been active in again, buying it at lower levels here. Starting to look to cap these gains at Telstra at around 5% dividend yield. We're seeing that compressed down to low levels, but our base case here on Telstra is essentially the stock remains buoyant into the February dividend. There's still a very strong chase for yield within the Australian equity market, and Telstra remains, a defensive favourite there. Westpac, again, around 5% EPS growth, delivering just over 5% dividend yield, starting to push up to the top end of the valuation range. I think the positioning ahead of the upcoming dividend, but post the div in November, we'd expect the banking stocks to consolidate and move sideways. So we've been active there in Westpac. We've actually been buying the stock at slightly lower levels and selling the covered calls. And then finally, just to summarise the stocks that we've been transacting in over the last week, Woodside Petroleum. So we've been buyers of this at lower levels, and we're selling calls up at around the $40 level, looking for around 8% EPS growth in 2014 out of Woodside, delivering close to a 6% yield. We see value down here, but starts to get a little bit expensive, up at around $40. And just to conclude today's recording, we'll go back and have a quick look at the XJO again. So from a portfolio allocation standpoint, we've provided growth within portfolios across sort of BHP, Woodside Petroleum. We've been focused on some growth and the dividends within the banking sector. Otherwise, we've sort of benefited from the rally in Stocklands. We've benefited from the rally in Brambles, Amcor, Transurban, even Lendlease. So we've had an exposure to the recovering property play in the Australian market. We've played the defensive names like Woolworths and Wesfarmers on the basis that they're largely moving sideways and driving that 10% income. I think from here, some of the growth themes start to look a little expensive, where the market's really captured some of that undervaluation in the resources and the banking stocks. So I think as we get into the ex-dividend period for the banks, they consolidate and move sideways. I think BHP and Woodside may have another 3 to 5% share price appreciation before they really start to run into resistance. But I think sort of from here, post the third quarter earnings in the US and post our dividend, I'd expect the market to consolidate but remain strong throughout November, December and into January. And really we'll sort of reassess things from a real structural portfolio allocation once we get into that sort of February dividend payment period. Thank you for listening in, and I look forward to speaking again next week.